Welcome back to the Financial Times. With me today is Governor Frank Keating, the outgoing head of the American Bankers Association. Thanks for being here. You've said in the past that Basel I and Basel II didn't get it right. Basel III is the effort to make things better. It's been 5 years roughly. What do you think has been the major impact of this significant regulatory change?
Look at liquidity, for example. This new initiative in the liquidity space is very complex. The average community bank has 35 employees. Now, if the intention of the Europeans, as I think was the case with the life insurance industry, was to keep us out so that we would not be effective competitors abroad, then they're doing a very good job of that by having their rules and regulations applied to us when they should only apply to those banks, U.S. banks, that are actively in the international marketplace. And most banks in the United States are not.
It's also been 5 years, relatedly, since Dodd-Frank. What do you think are sort of the major consequences of that? Where do you think?
Fortunately, I think the president will sign a repeal, or I should say an amendment bill, repeal of some measure in Dodd-Frank. And I hope that the Democrats and Republicans of goodwill will get together and do it. But it's not a perfect bill.
Sure.
It needs to be changed. Dodd-Frank came into that space and said, for example, in the mortgage space, we need to make sure that people who borrow money for a mortgage have an ability to repay the mortgage. Well, of course. I mean, why would I lend you money if I didn't think I was going to get it back? But down in the past, the dark road of pre-2008, that was going on. So they fashioned a fence line approach, 45% debt to income, no cosign notes, no dad or mother signing a mortgage note.
You're talking about for the qualified mortgage.
That's right. There ought to be creative financing opportunities for people to have a home, but there ought to be prudential regulators to make sure the loan can be repaid, and that's why you pay all this money and have all these regulators.
Again, there are no rules preventing banks from making loans like this. It's a question of how much they have to retain when they're making securitizations.
Banks are very risk adverse.
For qualified mortgages, not
right.
for
for a QM loan.
But it's, I mean, how is that a constraint relative to the option of simply retaining some piece and securitizing the rest?
Well, the bankers tell me that it's a huge constraint, that the rigidity of the loan, the requirements, the look back, basically on QM, you can sue somebody for 30 years. And those are the kind of things they want: plain vanilla, simple, obviously suitable down payment, debt to income ratio. They want to be in that fence line so that they're not going to be sanctioned or sued years later. You always will avoid pain before you embrace pleasure. And that happens in this space. And it happens in part because of Dodd-Frank.
So in terms of your model of how more prudential regulation would substitute for these kinds of rules, I mean, it seems like we would need to have many, many more regulators very actively involved in order to service a mortgage market of the size we have in this country. I mean, is that something that the ABA is supporting, kind of a mass hiring of people by the FDIC?
Well, Matt, think about this, and anecdotes to me are everything. They're perhaps just an anecdote to you, but I had a CEO call me from a very small bank about a month ago, $47 million bank. Now, there are some that think the regulators don't want any more $47 million banks, but this is a very small bank serving a very small community that's an affluent community. He said to me, "You will not believe this. I have 12 employees, 12. He said, 3 weeks ago, 14 regulators from the Federal Reserve descended on my business. They dominated my boardroom, took all the empty chairs and some. Business basically stopped because all of our people were responding to these 14 regulators with my 12 employees." Well, if they've got those kind of people to descend on a $47 million bank, there are a bunch of them out there that need some work.
The AIG settlement or announced trial ended yesterday. One of the striking, I think, points that the judge made was that, at least relative to AIG, the banks were treated remarkably well, and that this was unfair. What do you think about that?
In the case of AIG, it was a financial products unit that failed and brought the whole structure down. I remember one time I was having a conversation with an insurance regulator here in New York, and I said, these credit default swaps, I mean, those things are insurance products. They're insurance policies, and they have no reserves backing them up. This is crazy, except I guess the balance sheet of the company. And he said, yeah, but that's kind of above my pay grade. Well, the truth is, if it's an insurance product, it should be regulated as an insurance product. It ought to have sufficient reserves accordingly. And in the case of AIG, that thing that brought it down was not properly regulated. So,
do you think that applies to credit default swaps that banks issue themselves?
sure,
They should be
they're insurance
capitalized?
products.
The point the judge made that I found particularly striking, I think others did as well, is that there's nothing that prevented the government from doing that kind of more extreme treatment on other bailout recipients during the crisis. AIG, for whatever reason, was treated relatively more harshly. Do you think that, and the judge basically said this was unfair, that the banks, that there is a merit in Greenberg's case that the banks seem to have benefited relative to him. So I guess I'm just wondering what's the view of, what is your view on that? Like,
well, see, I misunderstood the news story, because I thought that the reason the judge slapped the government's hands was because the government took over and ran AIG,
That's right.
as opposed to just loaning the money.
Well,
but I would say both.
That was part of the terms, right? They
yeah,
got
but I'm
equity
saying
and they fired people and stuff.
If an AIG would be a SIFI today, or like a Prudential, or like a Metropolitan Life, then I think the goose and the gander should be treated alike. But now this could be appealed, this may not be appealed, who knows where it goes from here. But I think you ought to look at the significance of the enterprise, its failure, the impact on the economy at large, and you shouldn't say because it's an insurance entity it should be treated less severely or more severely than a banking entity. I mean, I think you ought to look at what it does and what the threat is in your regulatory decision.
Your term as head of the ABA is coming to a close. There's been a lot of things have happened in the past few years, whether it's settlements, new regulations, changes in the composition of the financial sector. What do you think has been your personal legacy and legacy of the ABA in all this? Well,
because I come from a community bank background, my focus was on let the big banks compete abroad and compete successfully abroad, but the community banks are the lifeblood of the communities from sea to shining sea. A lighter touch for community banks, like get Basel III out of their face, then I think that would be much better off. But that has been the thing that most concerns me, because I come from a community bank background, and to drive people out of business because the government wants it as opposed to the public wants it is really very unfortunate.
Thank you for coming.
My pleasure. Thank you, Matt.